Hi and welcome to Plimsoll's latest webinar. Now today we're going to be looking at the 5 steps of business failure that almost all previously failed businesses have followed. And more importantly, we're going to cover the steps needed to stop a business declining into ultimate failure. Now this couldn't be more timely with everything that's happening in the UK economy and global economy, I suppose, really, right now. Official figures have shown that there's been a huge rise in individuals seeking debt relief, while corporate insolvencies are also at levels that we've not seen for 15, 20 years maybe. Now, looking at the Insolvency Service, their latest data, which covers England and Wales, for the second quarter, over 6,000 companies have become insolvent in the 3 months leading up to June. Now, that's a 13% surge compared to the year before. And that's the highest number of insolvencies in the UK since the second quarter of 2009. So things do look quite bleak, really. Among those insolvencies, CVAs or CVLs, creditor voluntary liquidations, were particularly prominent with over 5,000 instances recorded. Now, that's the highest figure for a quarter since records began. So these statistics, they reflect the growing concerns about the impact of rising living costs, business expenses, which have affected the whole country following the conclusion of the pandemic and the financial assistance that was provided to support workers and companies through the pandemic. So a lot of companies clung on, relying on that support that's now been pulled. Then throw in Brexit, that's just added a significant cost for little to no economic benefit, and businesses starting to hurt, really. However, it's worth just taking a step back and taking a deep breath and remembering one historic reality that remains true throughout any crisis. As the UK economy flirts with recession or at best ongoing minimal growth, the one thing that Plimsoll likes to do is issue timely reminders in these times of uncertainty. Irrespective of what's happening in the wider economy, good companies survive even the worst of recessions. External events are often quoted as the actual cause of a business failure. It was Brexit, it was a sharp increase in costs, it was a supply chain issue. Absolutely, 100%, they're contributory to the ultimate failure of any business. But they're the final straw rather than the ultimate cause. You see, throughout history, it's poor companies that fail when conditions change, when shocks occur, or when the financiers lose faith. Despite what the owners and directors issue in their corporate press releases, the final catalyst for failure is often simply the straw that broke the camel's back. It's a business's inherent financial weakness that's been left to grow, that leaves them vulnerable and even leads to their downfall. Since 1987, Plimsoll specialised in helping companies assess their own health, benchmark their business alongside their main competitors, and look at key market averages. Now, we developed this graphical model and designed it so that business leaders, even those without any financial training or education, can have an early warning that there's been a deterioration in their own financial performance. Now, early assessment, as with anything, early assessment and remedial steps can stop any business failure. Plimsoll truly believes in making the steps early is key to increasing a business longevity. Now, the power of Plimsoll's unique model of analysis can also be applied to other companies that are within your sphere that matter to your long-term future. So from suppliers to customers to every company you deal with, just imagine the convenience of assessing and monitoring their long-term financial stability in a fairly easy-to-use model. You should never get caught out by a failure or miss a chance to pounce on an opportunity. Now, with that in mind, for those joining us today who are not current Plimsoll customers, we've mapped out the 5 steps that every failing company takes on their road to collapse, administration. In fact, 9 out of 10 companies that are currently in administration were rated as danger by Plimsoll at least 2 years ago. So these steps are a proven predictor of corporate distress and an early warning sign that things need to change. So business leaders have an opportunity at any point to remedy the issues. Good companies fix the problems at step 1, the very first step. And those that make it to step 5 often find that it's too late and have to look for somebody to buy their business, or ultimately they fall into administration. Step 1, fall in sales from assets and investments made. Now, the first step towards a business failing is when sales start to fall relative to assets and the investments that they're made, or sales don't quite match the level required for what you've put in terms of capital. Now, some companies will have invested into new people, new machinery, expanded into new territories, markets, products, and so on. Now, they get caught in the hubris of sales growth, and they invest for a rapid expansion that just doesn't materialise at the required level. For others, they don't necessarily expand their asset base, they simply maintain it. However, the sales generated from the assets employed start to falter or stagnate, like Thomas Cook, HMV, those sorts of examples. Now, for many companies, this can be a sign of falling demand or late product life cycle, but they have the same fixed costs, but demand's no longer keeping up. Now, in both cases, the rate at which sales are generated from assets falls. The business becomes less efficient at generating revenue from from the capital that it's invested. Of course, every company can absorb a year of reduced sales efficiency, of course, but that can quickly become unsustainable if not kept in check. The first step is crucial for business longevity, where early decisions have the biggest impact. Take a moment to think about your own company. Is it as efficient at generating sales from its assets as it once was, as it was a couple of years ago? Did you invest over the past year or so and got bigger, but you got less revenue efficient? Have you seen demand fall for some products or from certain business units? If so, you and any other business in that situation, you've got two choices. Number one, you either generate more sales from your asset base. Now, that's easier said than done, and it can be very difficult, especially amid the ongoing blowback from the likes of Brexit and the poor economic growth rates. And number two, you reduce your investments and even the overall size of your organisation and refocus back on the more sales efficient elements of what you do. Now, convincing shareholders and stakeholders to accept a regrouping and a smaller business can be a hard step, but it's entirely necessary. Step 3, profits start to fall. Now, companies that fail to assess and tweak their business model in the face of a declining rate of sales generated from assets will see profits come under pressure. It's a natural, unavoidable consequence of not being able to get enough revenue in from the staff, the assets, and the other resources that you've employed in your business. So sales, even much higher sales that are generated at a lower rate relative to investments made, are by their very nature much less profitable. You know, if company A generates 1 million sales from 200,000 assets and company B generates 1.5 million from 400,000 assets, the first company is by its very nature more financially robust. For company B, the cost of employing those assets will have doubled, but sales will only increase by 50%. Therefore, margins have to fall. At this second step, there's still ample time to reassess which parts of your business are delivering a sales return but at a profitable rate. However, the need to act has become much more urgent than it was in step 1. Step 3, falling profits eat into working capital. As we mentioned in an earlier part of the webinar, temporary short-term fails in profit margins can be absorbed. Certainly companies that invest for growth could argue that they've baked in a bit of a period when new investments need time to get up to operational capacity, and that's fine. You know, the expansion needs to bed in, and that can be especially true if you're bedding into new markets, new territories, and new products. But it's always important to monitor and have a plan around that. That you've got future projections for when returns will come in. However, a prolonged reduction in profit margins generated from sales eats into the working capital of the business. It reduces your company's ability to pay its way without having to sell off its fixed assets. So sustained reductions in working capital also leave a company in a vulnerable position where an unexpected cost or an unforeseen change in trading conditions can throw you into a significant loss. the consequences of which directly then feed into the next step. Now, as liabilities start to outpace assets, the company's ability to cover its debts without needing to sell the fixed assets it needs for normal operation starts to become compromised. And the business is increasingly beholden to the mood of its lenders, if you like. A business still has enough time to develop a recovery strategy to get back to generating sales and profits at an efficient level. But the remedial steps needed to recover now are going to be much more severe than had steps been taken earlier. But make no mistake, by step 3, the company really does need to make changes. Step 4, rebuild working capital by increasing borrowing. Step 4 is where the ultimate mistake that leads to overall failure is made. Instead of tackling the twin problems of low trading stability and then consequently profitability, a business that makes it to step 4 often rebuilds or tries to maintain whatever working capital is left by increasing borrowing. A business that's ignored all of the earlier warning signs will be attracted to maybe shifting short-term high-interest debt onto longer-term liabilities with slightly more favourable payment terms. Now, this has got the advantage of improving immediate cash flow, a margin and lower interest rate terms, which reduces the repayment outgoings. However, the overall liabilities of the business relative to its assets remain the same. The debt's still there. It gets even worse if they borrow a little bit more. Now, this increased lending, it's not been used to invest in additional assets for the furtherance of the business. It's simply been used to refinance debt and move it around the balance sheet. The Plymouth analysis states it's the level of liabilities relative to assets that determine the long-term health of a business, rather than whether it's short or long-term. Increasing debt at this step is wholly inadvisable for a business that reaches step 4. We'll cover why in the final steps in just a moment, but the key thing that companies can do and struggle to do to effectively restabilise a business that reaches step 4, a fresh injection of shareholder funds is the best option. Recapitalising the business with fresh liquidity from its owners, it has an immediate stabilising effect and buys the required time a business needs to recalibrate its business. However, so many companies fail to convince their shareholders to take this step. Step 5. Increased borrowing further destroys what profit remains. A business that traverses all the way through to step 5 is now in serious jeopardy. Whatever profit margins remain in the business are going to be even further diminished by the increased interest payments from the recapitalisation borrowing. That's particularly true in 2023 as the era of more expensive refinancing costs is upon us. Interest rates are high, By step 5, the business is so over-leveraged, it's increasingly vulnerable to nervous lenders or even suppliers that are pulling their support. Any short-term turbulence at all in trading conditions there's an outsized risk that it would trigger collapse. Of course, the board of any failed business will blame external factors. How many times you've heard a PR statement saying, due to, and then insert your reason here. And there is some reason or other that their competition and those operating in the same market didn't fall victim to. The problem was in the business. In every case of business failure, the board had ample opportunity and warning and multiple steps to monitor and address the issues within their business model. They chose to ignore them. They chose to ignore the warning signs and take the difficult decision. They chose not to get the business back to generating sales and profits that was commensurate with the investments that they made. And they just didn't focus on business longevity. Now, some companies at this late stage will be rescued in a takeover and subsumed into a larger group. Few ever regain their former glories, though, and most businesses at step 5 sadly fail. Those that do get bought out are usually the ones that have got brands, loyalty, longevity, and a larger business. Most smaller businesses, sadly, as we've seen from the statistics that we mentioned right at the very start, will fail. Plimsoll believes that every business failure could be avoided. If you heed the early warnings offered up by the Plimsoll model, all the signs are there. Our graphical predictor of company failure and strength is designed to show every business leader, even the non-accountant, when their business is failing to generate the requisite growth and profit, when liabilities then outgrow assets, and when the future of your business is being put at risk. We don't make these claims lightly. 9 out of 10 companies currently in administration were rated as danger by Plimsoll up to and beyond 2 years before their demise. On average, it takes the majority of well-established SMEs around 3 years to move through the steps on their way to failure. Larger companies can take up to 10 years. However, the end result is exactly the same, and the warnings are exactly the same also. The only difference is the patience and willingness of lenders and investors to extend credit to larger groups. Now, Plimsoll delivers this on a platform that allows its analysis. It allows you to form the same opinion on every competitor, supplier, customer, trading partner that you have. Spotting weakness and warning signs of failure in any company that's important to your long-term success is key to beating your rivals, avoiding picking bad trading partners, and being caught out by otherwise surprise failures. Plimsoll firmly believes there should be no such thing as a surprise business failure. Now, the following is a very brief video that showcases Plimsoll's unique model, just so you can see what a lot of what we discussed today is based on, and you can see for yourself how we can reveal a company's strength instantly. At Plimsoll, we believe these warning signs should always be available. They should always be up to the minute, and they should always be easy to digest. We do the analysis so you can take the relevant actions. For a demonstration of the Plimsoll model, or to learn more about the range of analytical platforms and products that Plimsoll provides, please call us on 01642 626 400 or click on the link below to request a callback. Well, thank you for attending, and the best of luck.